Hello everyone, this is Modified Darvas Box coming to you here after hours on September 28th. And I'm coming at you with a quick video here on the S&P 500 and why I think there's risk of it going down to perhaps maybe 4,000 or so. So before we get into that, just for people who don't know who I am, I made my own investing system based on the book How I Made $2 Million in the Stock Market by Darvas. Normally I look for bullish Darvas box patterns that look something like this, and I look for bearish Darvas box patterns that look something like that on the charts. However, one thing which I also look at is fundamentals, sales and earnings, but you know, in our liquidity-driven market where the Federal Reserve just keeps shoving money in, a lot of those fundamentals haven't really mattered so much. But I use them to keep tabs on the S&P 500. So I want to go in and show you why I think there is this risk. So anyways, before you look into charts, I want to show you how I get this data. And you can do this yourself. So I go to the S&P 500 website, and you scroll down and you click additional information, and then you click index earnings. That links you to a spreadsheet with all of the earnings information that looks like that looks something like this. You got to scroll down a little bit to find it. It's in this tab down here, estimates and PEs. I cut this up to make it presentable. And that's what I'm showing you here today. You can cut this up in your own way, but the data is all there and the data is all provided for you. So before we get into the Excel spreadsheet, let's just look at the chart. So in what's been going on the last few weeks, we had some downtrend. The S&P 500 ran about 12 weeks, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. And now the trend has changed, and instead of going uptrend, we are now going more sort of in a downtrend. 12 weeks is usually a rough period where, you know, a trend may peter out from one Darvas box breakout to forming a new one. And so far it's playing exactly true to form. It went up for about 3 months, and now it's going sideways and forming a new box. The question here now is price going to stay going sideways, or is price going to continue dropping and come down a lot more? Because that's what I think is going to happen. My target, which I'm putting out here, is about here. Well, I said 4,000, which is here, but perhaps the better target is the top of the prior box, which is about 3,900, call it. So between 3,900 and 4,000, worst case, it might even go lower, but probably not. But I thought 4,000 is a nice round number. Now we look at the NASDAQ. NASDAQ's got the same, I got the red lines in here. Let's look at the QQQ. But you can see here, the other thing which I don't like technically is these indexes are breaking below this long weekly moving average. On the S&P 500, this moving average has not been closed down. It has been pierced. It was pierced here, last pierced in beginning of March of 2021. But the prior time when it actually closed below the moving average was here back in October, November of 2020. So almost a full year above the weekly moving average. And now look what it's doing. It's threatening that it might close below it. We won't know until Friday, but it's indicating potentially a trend change. Now, stocks don't just go up for no reason. They go up for very valid reasons. You know, things in the market happen for a reason. In this case, the reason which I speculate is because of the sales and earnings and future business, which a company, stocks, the market is all going to do in the future. Basically, today's trading reflects a rough future, maybe 6 months ahead, maybe 9, but I think 6 months is reasonable. So anyways, if we get into that, we download the data for the S&P 500 index. Now, many people struggle how to read this. Like, how do I read these numbers? And that's what I'm here, and that's what I'm going to show you. So right here, this is today's price, closing price of the S&P 500. I can change this manually, and then all the future ones will change. So this is basically a static snapshot look at the numbers currently forecasted, either actual and forecasted in the index. This is the historical data right here. It's really cool because it goes all the way back to 1988. So you can see, how were things in the past? And like anything in finance, you always compare everything. Compare. How does this period compare to the last period? So, like I said, this is the current close. This is the forecasted earnings for the index. All 500 companies lumped together as an aggregate. This is the percentage growth, which is a quarter compared to the year ago prior quarter. So that's the quarter on quarter growth rate, percentage rate. And so you can see how does the future growth compare to the current growth. Right now we're wrapping up this quarter, which is just ending. This month is going to go away into the actuals, and then this quarter on September 30th is about to close, and soon we'll get new data from the companies that all we're going to report here in October, and that'll start to populate. The estimate of what all 500 companies are going to earn is about $44.28 per share. What I'm noticing is what's going to happen here in 2022, because we're getting ready to close this calendar year, and so far the future forecasted percentage growth is definitely lower. That is a trough, going from 171, 34, 49% to 2, and then 2%, and then God only knows what even farther off is. These are just wild ass guesses. Nobody knows what these numbers are going to be, but that's what they think it'll be, but susceptible to change. These are the PEs of what this EPS earnings is compared to today's SPX price. So what is the future value if I bought the S&P 500 today? How expensive is it on a PE basis? Remember, you're here to compare X to Y. So at this PE rate, that's about a 23 PE. 23 is not bad. On a forward PE, where you look at the earnings going forward here, it's a little cheaper. Whereas this one here in the 23s, that's backwards looking. That's how it adds it up. You take you add all four together and then divide by 4. So what this is telling me is that right now, a 23, call it 23, 21 PE, it's not bad, but at a 2% growth, yeah, the 2%, that's not so hot. Now up here in this box here, I created this because I came up with some levels as to how do we evaluate what the PE is. Is it expensive? Is it cheap? People on CNBC use those phrases all the time. Oh, this market's so cheap. Oh, this market's too expensive. As they do their thing. Well, what exactly does that mean and all that? So I came up with this table. We know from history that the Great Depression bottomed out at around an 8 PE. So we know that that's a low. Great Depression, how can you match that? We also know from the internet bubble of 2000 that really anything over 25, is bubblicious. And I found that by going through the historical PEs in this column. You just go back, scroll down, and you can see what it's been throughout history. So I came up with these slices here of what's weak, what's average, and what's strong. So I think we could have pretty much agreed that the market is still generally very strong. 23 puts it as a strong market level. And then, you get into 16 to 20, that's average. 12 to 16, that's kind of weak. And, things are going pretty bad if you're at 12 to 16. Usually we want to stay in this range right here, from 16 to 24. And if you'll notice, 16 to 24, we've been in that ever since we ended roughly the Obama terms and then got into the Trump terms. The economy's just been incredible. It's been incredible with how much money the S&P 500 companies have made, and the valuations have stayed pretty much, in this average to strong range. We haven't really gotten into the bubble range, which is pretty amazing in itself as well. But now things may be changing. And the change is because of this slowdown in percentage growth. So what you can see here is what I'm saying is on a PE basis, the 43.52 level that we closed at today is worth roughly a 23 PE range. But with this kind of growth, what's the historical comparison? That's where I came up with this range right here. The 2019 market here, where earnings per share growth was also single digit. Well, how did the index price that? Right here, you can see it priced it at about a 18 to 21, call it 22 range. So 18 to 22 comparison compared to this 23s. That means the 23s is kind of a little high. A little high in my opinion, at least. So how do we then come up with a target to see what might be, where the index might go? We start typing in different numbers and everything changes. At 4,200, PE is about a 22 level. Not bad, but doesn't match. All right, let's drop it again. 4,100. All right, 21 to 22. Still hasn't moved all that much. 4,000. Okay, now we're talking. That's a 21 PE level, which roughly comes up into this area right here. And there's your historical match. Trust me, the index is valued on inputs just like everything else. How much money are they going to make? And when you know how much profit the index is going to make, then you can come up with a valuation and determine how, what's the reasonable rate to pay for that stream of earnings. So I've got a preliminary target of 4,000, but let's see what 3,800 looks like. All right, 3,800. Now we're in the 20s. Yeah, if things get bad, if the Fed can't get this inflation under control, yeah, that might be valid. I said 3,700 from the chart. Oh, now we're in the 19s. All right, if it goes to there, yeah, then things are getting kind of bad. So that's how I came up with my target for the S&P 500 index, and also based on it on a PE comparison valuation. If you enjoyed this video on why I think the S&P 500 has risk down to 4,000, please hit the subscribe button on my YouTube channel so you get all future videos like this, which I may make. Thank you so much for watching.